Hey, listen, last week we were in Utah at the Best Ever Conference. If you weren't able to join us, this is going to provide a short recap of some of the top issues that were discussed by sponsors, operators, and syndicators about commercial real estate all across the country. For those of you that are actual owners, syndicators, or operators, if you tried to raise capital for your own deal or for other deals throughout the last few years, you know that it's been extremely challenging, right? There's been a significant amount of objective factors that have impacted the way that people have been able to implement their business plan at properties all across the country, right? Starting from when the Fed started to raise interest rates back in 2022, right? Historic amounts of changes in interest rates over 12 times, right? In such a short period of time, put significant pressure on a ton of deals, right? And many of those deals, starting even before 2022, were on floating rate loans. When you have a floating rate loan that's tied to LIBOR, and then now we have SOFR, when those interest rates go up and down, so does your interest rate at your property. And unless you are sufficiently hedged, meaning you have a rate cap in place that is able to cover the delta between what your debt service is and what the revenue is at the property, that puts significant pressure on your ability to actually implement your business plan. Then we saw the inability to actually raise capital, right? Investors, retail investors, your investors, they're exhausted. They're getting hit with member loan calls and capital calls, especially because of the floating rate loan and debt that you have in place in connection with commercial real estate. We also saw that the insurance markets in some of these places around the country, Florida and other places in the Sun Belt, were significantly hit because of catastrophic events that impacted their industry. And in some cases, there are only one insurance company in a particular market or submarket, therefore allowing those insurance companies to be able to basically do anything and everything to raise your premiums. All of those factors put significant pressure on your deal if you have an existing deal. And if you're invested in a deal, those types of pressures are what your sponsors, operators, and syndicators are feeling all across the country. So at Best Ever, these are some of the hot button topics that were discussed, right? There is a groundswell of optimism, though. There is a groundswell of optimism that the new administration is going to begin as they already have, as we've already seen, to put pressure on the Fed to actually lower interest rates as inflation gets under control. And so what we're hopeful of seeing is that you're able to manage those three things, right? From the ability to raise capital for new deals, the ability to talk to your lender about your existing loans if they are in distress, and get your handle on your insurance costs. So us at Kelley Clark, because of the sample size that we see, we see somewhere between 100 to 200 deals each and every year, and we're able to help structure those things from letter of intent all the way to the closing table. What we did is we actually went out and helped solve what we believe is an amazing partnership with insurance carriers to be able to help drive down your insurance costs. So if you're somebody that has an existing deal where your insurance costs and your premiums are out of control and you don't know what to do, you just know that there's a symptom, you don't really know what to do about it, you need to give our office a call and we'll talk to you about it. Step two, if you have a deal where your revenue at your property is insufficient to cover your debt service, or you're in a distressed market, or you even know that your property right now is in default, either monetary default or non-monetary default because of your debt yield, your DSCR, other objective factors that your lender uses to figure out if your loan is actually stabilized or not, you need to give our office a call because we've been able to help restructure and or modify existing loans. That might take the place of potentially a forced sale before foreclosure. That might take the place of injecting new capital with an outside third party or a preferred equity partner. That might take the place of having to restructure and or your capital stack internally in your entity to make sure that you can actually survive or avoid foreclosure and potentially give equity back to your investors. And number three, We basically described in an educational format how you can raise capital in a distressed market, how you can incentivize your general partners and your other co-sponsors that are coming alongside of you to do something that maybe you haven't thought about, to essentially be able to compliantly and legally raise capital the right way so that you can actually survive until we start to see the market turn around, which we are starting to see slightly. We're seeing more deal flow in 2025, and there is a swell of optimism that theoretically we're going to start to see rates come down and lenders be more pragmatic in how they approach the modification and restructure game. So hope this was helpful for you. Those are some of the highlights at the Best Ever Conference for 2025. Look to see you at the next conference or at our office, wherever you might be. In the meantime, happy hunting.